What if I told you that buying a digital coin could help fund the US government without Congress lifting a finger or China buying another treasury? Sounds like Crypto Ponzi 2.0, right? But no, it's actually law. Enter the Genius Act, a stablecoin bill with a fiscal twist so sneaky it might just be brilliant. Or genius. Welcome to FluxFolio Finance, where we dig through the monetary rubble to find the fiscal gems. The Genius Act, short for Guiding and Establishing National Innovation for U.S. Stablecoins, was signed into law by President Trump on July 18, 2025. It's the first federal law to regulate stablecoins, those digital assets pegged 1-1 to the US dollar or treasuries. But don't be fooled by the crypto packaging. This isn't just about making Tether legal. It's about solving America's debt dilemma by crowdsourcing demand for treasury bonds. One Venmo payment at a time. In this video, we'll explore how the Genius Act transforms U.S. debt financing, reinforces dollar dominance, dismantles parts of the traditional banking system, creates a regulatory moat for big players in crypto, and yes, spoiler alert, it could also blow up in spectacular fashion if a stablecoin run hits the fan. So buckle up, folks. Crypto regulation just got weaponized. Let's start with the basics. Originally introduced as Senate Bill 394, the Genius Act became S-1582 after some congressional sausage-making and was passed in mid-2025 with broad bipartisan support. Yes, bipartisan. Miracles do happen. The law creates a new class of financial entities called Permitted Payment Stablecoin Issuers, PPSIs. If you're not a PPSI, you can't issue a stablecoin in the US period. After a 3-year grace period, even offering unregistered stablecoins, looking at you, Tether, becomes illegal. Stablecoins must be backed 1-1 with US dollars or short-term treasuries, and issuers must publish audited monthly reserve reports. They also have to comply with anti-money laundering laws and have technical capabilities to freeze, seize, or burn tokens. Oh, and here's the kicker. The Genius Act explicitly states that these stablecoins are not securities or commodities. Sorry, SEC, not your sandbox anymore. Think of this as the US finally deciding to regulate crypto by absorbing it into the federal financial bloodstream. Now let's get to the juicy part. Debt. The US Treasury has a problem. It needs to sell trillions in bonds without scaring markets or relying too much on foreign buyers. So, why not get the public to help? Stablecoins under the Genius Act must be backed by treasuries or dollars. That means if everyone and their Uber driver holds stablecoins, the issuers, like Circle or maybe Walmart, need to hoard treasuries, lots of them. Tether already holds over $118 billion in US T-bills. Analysts say this demand could shave 14 to 24 basis points off yields. That's like giving the US government a backdoor interest rate subsidy with zero congressional debate. Genius indeed. This creates a retail-driven bond market where people buying stable coins for gaming, tipping, or buying coffee are, wait for it, funding the government. But wait, there's risk. If a major stablecoin depegs or if there's a confidence crisis, issuers may need to sell treasuries fast to meet redemptions. That's a fire sale, a digital bank run on the treasury market. And yes, Wall Street would absolutely freak out. So while the Genius Act may temporarily lower borrowing costs, it also installs a self-destruct button labeled Stablecoin Panic. Congratulations, America. You just created QE on-chain. If you thought this was just about crypto bros getting audited, think bigger. The Genius Act is a geopolitical flex. The White House says this law will cement the US dollar's status as the world's reserve currency By turning stablecoins into US-backed payment rails, the dollar becomes more than dominant. It becomes programmable. While China rolls out its e-CNY and the EU debates digital euros over croissants, the US outsources innovation to private firms like Circle, PayPal, and Amazon, then slaps federal oversight on top. Who needs a CBDC when you can get 100 million people to hold digital dollars voluntarily? The genius here isn't tech, it's strategy. Stablecoins backed by Treasuries increase global dollar usage. Every cross-border payment, every remittance sent in USDC adds to dollar demand. It's a soft power play against de-dollarization and a hedge against BRICS CBDC experiments. This isn't decentralization, it's weaponized convenience. America didn't invent stablecoins, but it just figured out how to use them like a monetary Death Star. And China? They're still asking citizens to scan their face to spend 50 digital yuan. Now let's talk about who should be very, very nervous. Banks, because the Genius Act creates a path for stablecoin issuers to apply for Federal Reserve master accounts. That's right. No more needing JP Morgan to clear your payments. Circle could become its own digital central bank. Even spicier, Amazon and Walmart are exploring issuing their own stablecoins. Why deal with Visa's fees when you can make your own money and use it at the checkout aisle? Imagine using Walmart coin to buy bulk diapers. What a time to be alive. Meanwhile, traditional banks are losing deposits. Why keep your dollars in a checking account when you can hold tokenized cash backed by treasuries, spend it instantly, and never pay overdraft fees again? This cuts into lending, credit, and liquidity, the very plumbing of the US banking system. In short, the Genius Act doesn't just regulate stablecoins. It kicks banks in the shins while handing tech giants the keys to the vault. RIP overdraft fees, you won't be missed. But it's not all disruption. There's massive innovation too. With clear regulation, stablecoins now unlock real-world use cases, cheap cross-border remittances, payroll automation and tokenized salaries, rewards points and brand tokens. And who benefits? Platforms like Ethereum, Solana, and Coinbase. They power most stablecoin infrastructure and now gain legal certainty and investor confidence. This clarity also accelerates tokenization, bringing old financial products into a new digital wrapper. Tokenized US Treasuries with 24/7 liquidity, on-chain mutual funds and equities, smart contracts that automate dividends or coupon payments. The financial system is being rewritten line by line in Solidity, and the Genius Act is the license. Let's not get too excited, because with innovation comes serious risk. First, systemic fragility. If a popular stablecoin collapses, mass redemptions could trigger a rapid unwind of T-bill reserves. That's forced liquidation risk, like a 21st century bank run. Second, consumer exposure. These coins aren't insured by the FDIC. Redemption rights vary. Some coins can even block withdrawals under extraordinary circumstances. Third, legal ambiguity. The Genius Act only regulates payment stablecoins. That leaves DeFi protocols, yield-bearing tokens, algorithmic coins still floating in gray zones. Fourth, market concentration. Compliance is expensive. That favors incumbents like Circle and PayPal, possibly choking out smaller innovators. Fifth, privacy erosion. The law mandates technical capability to freeze, seize, or burn coins. That's necessary for legal compliance, but dangerous if abused. The Genius Act solves many problems, but leaves just as many shadows. So what's next? The Act becomes fully enforceable, the earlier effect 120 days after final rules, or 18 months post-enactment, so around January 2027. In the meantime, here's what to track. 1. USDT versus USDC. Will Tether adapt or exit the US market? 2. Institutional adoption. Do Amazon, Visa, or Wall Street launch coins? 3. Legislative follow-ups. Watch for the Clarity Act for broader crypto rules, and the Anti-CBDC Surveillance Act, Trump's push against government digital money. 4. International pushback. Will Europe and China tolerate a US stablecoin-led global finance system? Also, will stablecoin use cannibalized bank deposits, or will banks co-opt it through tokenized dollars of their own? The Genius Act isn't just a crypto bill. It's a strategic realignment of fiscal power, monetary policy, and financial infrastructure. If successful, it could lock in global demand for US debt, cement dollar dominance without a CBDC, and modernize payments across commerce and capital markets. But if mishandled, it risks triggering Treasury market instability, increasing financial centralization, and enabling surveillance rails for programmable finance. This is the bet Washington just made. Thank you for joining FluxFolio Finance. If you found this episode insightful, hit like, drop your thoughts in the comments, and subscribe to follow the evolving architecture of the digital economy. Until next time, stay sharp, stay sovereign, and stay invested.